The following paid commercial program is brought to you by TD Wealth.
Tonight, 2015 is now history, a year in which many investors may be saying good riddance, with stocks dogged by depressed oil prices, a slowing Chinese economy, and the specter of rising U.S. interest rates. Will we see more roller coaster market action around the world in 2016? And where are investors most likely to find opportunities? With over $290 billion in assets under management, Bruce Cooper, Chief Investment Officer of TD Asset Management, will tell us what he sees as the key investment themes for this year. That's coming up on Money Talk.
Hello, and thank you so much for joining us tonight. Well, what a start to the trading year. China sells off by about 7% on the first day of trading. Its currency is dropping, oil is dropping sharply and to a 12-year low. And the loonie and North American markets have been moving down with them again. For those who are looking for a change of pace from last year, our next guest says that probably will not happen. In fact, some of what was happening last year may intensify this year. We're lucky to have with us tonight Bruce Cooper. He's Chief Investment Officer with TD Asset Management to have a long conversation about everything that he sees. It is nice to see you.
Great to be here.
That was an interesting start to the year.
Yeah, a bit of a tough start. We're only 3 days in. It feels like we've been back from holiday for 2 months, probably.
Yes, I know exactly. The vacation glow was gone,
Exactly.
Just like that. I want to start things off with just some perspective on a little bit of what happened last year, and then we can kind of talk about themes for next year. Let's bring up a chart of we have a year of this is the 2015 price returns on the market, so people can take a look at that. Again, not total returns, price returns, and it kind of tells a story of what happened last year. Not a fantastic year.
Not a fantastic year. Obviously, the green line there is Canadian equities, which had a particularly tough year on the back of commodities being very weak, especially oil, and other markets like the U.S. kind of wobbling in and around zero in local currency terms. Of course, for Canadians, if they owned U.S. stocks, they actually did pretty well because the currency was so strong, or the Canadian dollar was so weak, depending on which way you want to look at it. So diversification did actually help you in 2015 if you owned some bonds and some foreign equities because of the currency component. But it was a volatile year, and certainly there were times when it didn't feel very good, and Canadian equities in particular were very difficult.
When we talked before, I know you had said last year it was going to be low growth, low yield, low returns, and more volatility.
Yeah.
Are we going to have a rhyming year with 2016 with 2015?
Yeah, I think it is a little bit more of the same. The low growth theme is one we've been talking about really for 6 years, and it's a global phenomenon. Of course, here in Canada, the economy is sluggish, but it goes well beyond Canada, and I think is a global phenomenon. And underlying that are lots of secular forces like demographics and high debt, and so we think that the low growth theme will be pretty persistent, and because of that, we think interest rates will stay low. It's going to be more challenging for companies to grow their earnings, and that will kind of feed into equity returns. So, yeah, a challenging environment. Kind of across the board.
What I was hoping to do, if we could, if you're okay with this, is I'd like to start and kind of, start with the big picture, and then we're going to narrow this down, and by the end of the show, people understand kind of where what your recommendations you move forward. So we have a chart that I actually got from your folks, and let's bring it up here. Title here is Opportunity or Risk, and it shows, of course, the world.
Nice little map there.
It's a nice little map. U.S. Federal Reserve, of course, one of the big news in the States. Weak Canadian growth, European imbalances, slowing growth in China, and Middle East unrest. So let's dissect that if we can. And where would you like to start on that map?
Why don't we start in China? Always people interested in China, obviously, one of the largest economies in the world, and always lots of news and views on that country.
I just interject because just in the past 2 days, and we had service data that came out, slowest growth in 17 months. Manufacturing data came down, so it's really, it's always a center of attention, but kind of slapped us in the first few days of trading.
I think from our perspective, there's two big things going on in China. One is growth is slowing. That really happened last year. The official numbers not so much, but I think the real economy probably slowed more than the official numbers would indicate. So I think growth is slowing is one big theme in China. And then the other theme is that you're going through this transition where they're trying to move from an economy driven by investment and manufacturing to one that's driven more by consumption and consumer activity that we would recognize. So both of those things going on at the same time can create risk and volatility, and there's no guarantee that that transition will be smooth. We hope it will be, but there's no guarantee. And so I think a lot of the choppiness you see out of China in the numbers, in the economic numbers, or indeed in the market trading, comes from kind of the journey along this path is not a smooth one.
I wonder, and you bring up a really good point. They have, and I can't remember, is it a 5-year plan, or I don't have this plan in place, of which their intent is not to manage the market. Their intent is to transform the economy and the country. So should we be paying as close attention to what's happening in the Chinese market, given that they are undergoing structural change and doing so much?
I think the Chinese stock market for Canadians is a bit of a red herring. It's something we shouldn't pay that much attention to.
But it seems to trigger,
it can, and it create a little bit of noise. But I think from a longer term perspective, even months and quarters in a single year, it doesn't have that much impact. Of course, very few Canadians have actual investments in China.
But it's more commodities and oil and that sort of thing.
Exactly. And I think the Chinese economy is important for Canada because it consumes a lot of commodities. And of course, as they move from an investment-driven economy to a consumer-driven economy, there are concerns that they will consume fewer commodities like steel and iron ore, and that does appear to be happening, by the way. So, that is at the margin negative for commodities. And so I think it's the real economy in China that we should be worried about, or not necessarily worried about, but focused on, and then think about the impact that has on our economy and our markets. And I think one perspective I've had is we live in this low growth world, and as China slows, it just reinforces or exacerbates this problem we have with low growth. So it's not that China created this problem. Europe's been growing slowly and North America's been growing slowly, but it reinforces this.
Let's, in terms of that map, Middle East unrest, getting...
Very topical, obviously, with some of the events in Iran
and Saudi Arabia.
From a political perspective, this is one of the things I worry most about. We've got, obviously, deep divide between these two Islamic communities, the Shiites and the Sunnis, which are represented in these two big countries, Saudi Arabia and Iran. The big economic importance of the Middle East has historically been as a producer of oil. You could imagine volatility in the region could have an impact on oil, but of course it can have other impacts on broader movements of refugees. We're seeing that with Syria, terrorist incidents, risk of war. And so I think from a sort of long-term or mid-term geopolitical perspective, it is a worrisome situation in the Middle East for sure. And I think it's gotten worse in the last 12 months would be my impression.
And interesting too, you mentioned obviously the impact of, what's happening in Syria, those refugees moving en masse into Germany, being absorbed, the impact that's going to have there as well.
It's a very meaningful issue in Germany particularly. I mean, we think in Canada, we're looking to take in 25,000 or whatever, which is terrific, I think. But in Germany, they've taken in, 1 million or whatever it is. It's a huge commitment and politically challenging. At the time, Germany's economy is okay, but Europe as a whole, the economy is not great. And when the 25,000 refugees come to Canada, of course, we selected all of those. A lot of those 1 million refugees going to Germany, just arrived on the shores of Greece or wherever. And so, it's a little less manageable than the situation we have here. So, I think that's a challenging political situation and a challenging economic situation that Europe's addressing.
All right, stay with us when we come back. We've got through part of that map. We're going to bring the conversation back to North America right after the break, and then we'll be talking a bit about what companies are facing. You're watching Money Talk. I'm here with Bruce Cooper, Chief Investment Officer at TD Asset Management. We'll be right back. And welcome back. I'm here with Bruce Cooper. He's Chief Investment Officer at TD Asset Management. We've been talking about the climate of the world, metaphorically speaking, in terms of what is happening and all the challenges in terms of the big global economic picture. Let's bring up the map. We've been talking about slowing growth in China, Middle East unrest. We've been talking about European imbalances, both fiscal and perhaps population, as is coming in. And that leads us to the left side of the screen here about the United States economy, the weak Canadian growth. I want to start with Canada just because, but I mean, we talked a bit about China slowing commodity growth, oil, and therefore Canada.
Yeah,
harshly.
I think the Canadian economy is clearly sluggish. It's obviously regionally there are differences.
Yeah.
Oil prices being low is having a very dramatic impact on spending by companies. So we're seeing, dramatically reduced capital expenditures in the oil sector in Alberta. I think that's going to persist, for sure through all of 2016, probably through 2017 as well. Even if oil recovered from where it is today, companies are not going to want to invest unless oil gets much, much higher. Right. So I think the economic impact of low oil prices will be with Canada for quite a while.
Yeah.
Obviously, the first half of 15 growth was, somewhere around zero. Maybe it got a little better. But I think we're in this kind of subpar growth environment for Canada. Housing has been pretty strong, clearly in Toronto and Vancouver. But you can't drive the whole economy just by housing into markets. So
right.
I think the Canadian dollar being low will facilitate a transition of the Canadian economy over time, which is one reason we think the Canadian dollar will stay low, for a reasonably long period.
Sub 70?
Yeah, I don't know. I'm not. It's obviously hard to call direction. We're pretty close to 70 as we sit here.
Yeah.
So if we went to 69,
it only takes half a cent.
That wouldn't be a big move.
Yeah.
I'm not saying it will certainly go much lower, but I could see it staying at this low level for quite a long period of time. Because at this low level, I think the Canadian economy is more competitive.
Yeah.
Which means we can attract investment maybe outside of those traditional commodity sectors.
In the company side, in terms of government side, I mean, the specter of negative interest rates certainly is going to have an impact as well.
Yeah. I think the Bank of Canada has been trying to get the dollar down, I think, is part of it, because they understand that the low dollar, just what I've been saying, the low dollar will help transition the Canadian economy. So, my guess is as long as the dollar is kind of staying weak, they don't need to go to negative interest rates. I don't think it'll have a big impact. If we went to negative rates, it wouldn't have a big impact on borrowing costs, which are already at, exceptionally low levels. I'm not sure lower rates would stimulate much economic activity, but I think it's through the currency mechanism that it could help, over the kind of medium term.
I've saved the best to last.
Fabulous.
Yes, the United States.
Yep.
I'm not sure, in the land of the blind, the one-eyed man is king, but we'll, the Fed has come out, of course, made their move, very well telegraphed. I mean, it was the biggest non-event that we probably had in a long time.
Right.
But the U.S. economy, what is your sense? Because, the data we've seen recently, and I would say we've seen manufacturer weakening, we've seen inventory build up. It's not been, tilting in a really positive direction.
I think that's right. The U.S. economy is, technical word, I would call it okay.
Yeah. Which is pretty good right now.
It's been growing at about 2%. There have been pockets of strength. The job market's been pretty good. The housing market's been pretty good. Obviously, new car sales have been pretty good. But the flip side of the Canadian dollar being weak is the U.S. dollar has been strong.
Right.
Obviously, it's been strong against not just Canada, but the European currency and the whole kit and caboodle. And that is having an impact. Of course, low oil prices having a huge impact on Canada, but they're having an impact on the United States too. All these shale producers, CapEx is being slashed there very dramatically. And manufacturing, as you referred to, is under a little bit of pressure. So, I think the U.S. is okay. It's still growing. I anticipate it will continue to grow. But, I talked earlier about we live in this low growth world. The U.S. is the largest economy in the world. And, it is one of the engines of that low growth, if I could put it that way. It's sputtering compared to what we saw in the 80s, the 90s, or the 2000s before the financial crisis. It's just slow.
What does this mean then for, I mean, one of the big trends we saw in 2015 was these big mergers, companies, looking to grow by buying. So, Budweiser and Miller, Dow Chemical and DuPont, Pfizer and Allergan, I mean, the list goes on.
Yeah.
Are we going to see more of that, do you think?
I think it's possible. I think the rationale for that is two big drivers that I see. One is interest rates are very low, so money is cheap, and so if you're taking over a company using debt, it's cheap financing.
Right.
So that's a big driver. And second of all, coming back to these ideas of slow growth, for companies, it's hard to grow their revenues. And so if they're trying to grow their earnings, they can buy another company, and often when you buy another company, you can reduce costs.
Yeah.
And so I think companies are hoping they can grow earnings that way. Of course, mergers historically have been risky. Some work and some don't. But they're hoping they can grow earnings through that mechanism, partly because organic growth is very challenging in this environment.
All right, stay with us. When we come back, we're going to draw it all to a big conclusion. We'll get Bruce's thoughts on equities, valuations, and outlook, what their group is recommending as they look ahead. You're watching Money Talk. We'll be right back. Welcome back. I'm Kim Parlee. I'm here with Bruce Cooper. He's Chief Investment Officer at TD Asset Management. We have been, again, talking about the state of the world as it is in terms of what is going on, what it means for investors. And so we've talked about geographically what's going on, and I want to just quickly ask you about valuations. Where are we? I mean, we've seen the markets have come off a bit in the first few days, but where are we sitting right now?
So on the equity side, we view valuations as in the range of fair. So we don't think stocks are outrageously expensive, but of course they bottomed in 2009 and then have gone up a lot in the last 6 or 7 years. We don't think they're outrageously cheap either. So if you had to put a P on it, in U.S. equities we're somewhere around 16 times earnings. We have a bunch of fancy quantitative models which tell us that the P multiple should be around 16 times.
Right.
So we don't think there's a big story there that tells you they're either too cheap or too expensive. They're around fair value is what our view would be.
Now, your group has something called the Wealth Asset Allocation Committee. Just what is it? And because you basically meet on a regular basis to decide strategically what needs to happen.
So we meet on a monthly basis. It brings together leaders from across our business in the U.S. and Canada, people that focus on fixed income and equities and asset allocation as a separate discipline. And we're really trying to provide kind of advice and guidance to our clients and our internal portfolio managers about how they should construct portfolios by saying, here's where we see opportunities, here's where we see risks, and we come out with return expectations for different asset classes.
Okay, well, let's talk about a bit of them if we could. So what is the latest recommendation? Like, given the state of the world, what we've talked about?
So obviously some of the comments I have made today would suggest that we are cautious, and we are cautious. That's different from saying we're outright negative. We're just cautious, which to me means you want a diversified portfolio of quality assets, I think is the way I think of it. I think for Canadians, the role of diversification came through so powerfully in 2015, where, as we talked off the top show, lots of things were going wrong, but if you had some U.S. dollar assets in your portfolio, either bonds or stocks, you did okay. And so in this risky environment, having a diversified portfolio is very important. I think from my perspective, that would include both what we would call high-quality equities, companies that can pay good dividends and grow their dividends over time. It would also include some fixed income assets. It would include some global exposure, including U.S. Exposure. It would probably include today some cash, so you have a bit of dry powder in case prices fall, and you can redeploy then. So diversified portfolio, that will help you navigate this turbulent environment and very much up the quality curve. Companies that are built to last, that pay good dividends, have strong balance sheets, generate consistent cash flow. That's where you want to focus. This is not a time to swing for the fences. This is a time to be conservative.
Yeah.
Live to fight another day. I don't think you're going to get rich in 2016.
Yeah.
But if you've got a well-diversified portfolio, you'll be fine.
Right. You talked about having looked at the recommendation, expecting low single-digit returns in 2016 for equities.
Low single-digit returns in fixed income and low to mid-single-digit returns in equities.
Thank you. Okay.
So those are modest expectations.
Yep.
Be similar to last year in a lot of ways. Of course, the U.S. market was basically flat last year.
Yeah.
And Canada was down. Europe was up a little bit. So
Yeah.
I think it's consistent with what we saw in 2015.
This is just my active listening. I'm repeating back to make sure I understood everything. So geographic preference, you're saying also developed markets over emerging, especially right now.
We find emerging to be an area of risk. Of course, the emerging world is a pretty big world. Latin America is probably having the biggest problems because it's very commodity focused, and the slowdown in China, ironically, is having a bigger impact on a place like Brazil than it is on China itself.
But do you think also we could see some impacts of like the Chinese currency following, and then other currencies in Asia? Like people, is this an Asian currency crisis we could see kind of starting up?
Well, we are cautious on the emerging world because we see risks like that. We see currency risks. Also, you tend to have lower quality governance at companies in the emerging world. So, if the world's a slower place, I'd rather stick with higher quality, management and legal structures you understand, as opposed to chasing risk in the emerging world.
How, and I guess the tough part for a lot of people, though, when they see how 2016 has started, and you talk about the high quality dividend growers, I mean, you talk about them being a fair valuation at 16, but they feel expensive, I think, for some people. I mean, it just seems like, that's everybody's going after the same thing. Or they're not bargains in a lot of cases, but our view has been, if you could put together a portfolio of high quality stocks that have dividend yields of 2.5%, 3.5%, 4% even, those should perform reasonably well in an environment where bonds yield 1 or 2. Obviously, they'll be more volatile and there'll be downs as well as ups. But we encourage people to take a long-term perspective. For most people, they're trying to think about their retirement, which in many cases could be many years hence. And stocks will go up and down. That's the nature of the beast. But if you own a portfolio of stocks that year in, year out, grow their earnings, grow their dividends over a 10-year period, that will produce a good outcome. So at times like this, you want to have the right asset mix, conservative, and then don't get too caught up in the daily noise because you pull your hair out, you end up looking like me. On that, we'll leave it. Bruce Cooper, thanks so much. Bruce Cooper, Chief Investment Officer at TD Asset Management. Thank you for joining us tonight. Any comments or questions that you've seen anything on the show, or if you would like someone to take a look at your portfolio, you have some planning questions, you can always email me at moneytalk@bnn.ca. I will get you in touch with someone who can answer those questions for you. Thanks so much, and we'll see you again next week.
The preceding paid commercial program was brought to you by TD Wealth.